Hey guys, Jared Wesley here of Live Traders, back for another Wednesday lecture. This week's lecture, guys, is on candlestick bars, and not just individual candlestick bars, not just red bars or green bars, but there's three questions that we're going to ask this week, and we're going to talk about and we're going to answer them, okay? One, how does an individual candlestick bar form, okay? How does it form? Bottoming tail, topping tail, doji bar, wide range bar, green bar, red bar, etc., okay? Where does that bar form on the chart? Is that bar forming after 8 green bars? Is it forming after 2 red bars, okay? And how did it get there, okay? So how is the individual bar forming? Where is it forming, and how did it get there? So those are the three topics that we're going to discuss on this Wednesday's lecture, guys. It's about 35 minutes, so not super long. You definitely want to stick around to the end of it, guys. There's a lot of great information in there. I think all of these lectures are good, but some of them are more important than others, guys. And this, candlestick bars are the foundation of technical trading, guys, okay? So obviously we talk a lot about trade management. We talk a lot about money management. That's account protection. But when it comes to actual charts, physical charts, guys, how and understanding how candlesticks form, where they form, etc., and so forth is really, really important. And another comment I want to make, guys, okay? Look, if you want to be great at technical trading, you're going to have to master the psychology, the emotions, as well as the technical charts. But the one thing you also have to remember here, this is not a get-rich-quick business. This is not some scheme. This is not poker. This is not a Ponzi. It's none of those things, guys. It's a legitimate business. So stop, guys, all the horse shit and all the BS when you see somebody, oh, I turned $200 into $100,000 in 37 days, guys. That's garbage. That is not how real traders work. That is not how hedge funds work. That is not how professionals work, guys. When you are trading with a retail account, you should be looking for 100 to 200% a year return, okay? When you are swing trading, you should be looking for a 30 to 50% a year return, guys, all right? I want you to think about this. I want you to think about this, guys. If you took a $100,000 swing trading account and you made 50% a year, all right, before the 10-year mark, you would be a multi-millionaire. A multi-million, not 1 million, not 2 million, not 3 million, way more than that. If you could repeat 50% year over year for 10 years on a $100,000 account. One other quick thing, guys, that I want to mention to you guys. Trading today was mediocre. It wasn't great. It wasn't bad. It was just so-so. I got a decent trade on GIS. I got out of it a little bit early. I'm going to put that on the screen for you now. And the reason I'm putting it on the screen, guys, is these are things that I teach in professional trading strategies. Most people out there never talk about pre-market charts. They never use pre-market charts. Well, GIS today, there were no entries on this stock, none, unless you used a pre-market chart, okay? I put this entry out there 5 minutes before the market opened, guys. I gave it to my traders in the chat room, on StockTwits, on Twitter, everywhere before the market opened, okay? That's key, that's key. It was a 15-minute buy setup at level 1 support over 48.50 with a stop at 48.10 using pre-market data, guys. Pre-market data can be very, very valuable. Very few people talk about it. And if you didn't take the entry that we got on the 15-minute buy setup using pre-market charts, then you weren't catching GIS. And if you did, you whimsically bought it with no technical pattern, guys. So again, use pre-market charts. They're very helpful. You can see on the screen the trade that I took, guys. Always, as always, account number up. I made $436 on it. I probably should have made $600 or $700 on it, but I got out a little bit before I should have. Nonetheless, it was an okay day. Not a great day, but not bad for 30 minutes of trading. Let's get to the lecture, guys, on candlesticks. Have a All right, guys, today's topic that I want to talk about, all right, that some people think is a very simple, very basic topic, is candlesticks. And we're going to talk about candlestick formations and inside them. And we're going to go look at some charts because I am deeply concerned about what I'm seeing a lot of people doing. Okay, I am seeing a lot of people taking extended trades and saying, hey, that stock's strong, let's just jump in it. Okay, so I'm not going to spend a long time on the basic candlestick, like who's in control. I want to talk more about candlestick formations, okay? A month or so back, we talked about support and resistance and how you arrive in a certain area. I am doing this, and it's not a repeat, but there is overlap because I am very concerned about what I see a lot of people doing. Remember, guys, before I even dig into this, trading is a challenging business. This is not a get-rich-quick overnight thing. What I mean by that is don't get caught up in the FOMO, the fear of missing out. I understand you're seeing all the Google advertisements and Twitter this and Twitter that, and everybody's turning $10 into $10 million in 32 days. All right, that's all bullshit. All right, it's not real. If you want to make money in this business, you're going to do it over the long run. We have a swing trading newsletter. The goal is to make 50% a year. We have intraday trading where the goal is to make 100 to 200% a year. Now, if you have a prop account, maybe some of those numbers can be a little bit higher. All right, but you're not likely swing trading your prop account either. But at the same time, you're going to do this by hitting singles, doubles, and triples, not by hitting home runs and grand slams all the time. All right, not everybody can be Mike Trout. You guys get the point, though. So stop looking at a stock that's up 8 bars in a row and you're like, ooh, let's buy the high. And then it immediately pulls back against you and you sit there with your hand in your pants going, I don't know what just happened. Yes, you do. You got caught up in it and you thought, man, this thing's going to go higher. Why? Because you saw it happen before. A stock was up 8 bars and magically it went up 12 bars. And you think, well, next time it's going to do the same thing. No. The more something is up, the more likely it is to pull back. It doesn't mean it can't go higher. It's just that at the end of the day, you have to appreciate and respect the fact that we are pattern traders. No pattern, no trade. One more time. No pattern, no trade. We just talked about GIS today. If you weren't looking at pre-market charts, you had no business buying GIS because there was no pattern. But if you were looking at pre-market charts, it had a 15-minute buy setup, which is what we took. Okay? No pattern, no trade. I want you guys to get out of this get-rich-quick gambler's mentality. Too many traders are like a poker, you use the term on tilt. Too many traders trade on tilt all the time. Just because you didn't hit your max loss for the day doesn't mean you didn't trade on tilt, right? You could have just got lucky that day. Doesn't mean, because you took 10 trades, they were all viable and valid entries. So I want you guys to just settle down, slow down, and wait for your patterns. You shouldn't be taking more than 3 to 5 trades a day anyway. There's no reason for it. Occasionally, maybe, but most of the time, no. All right, so let's take a look here, guys. These chart keys, all right, really important. These are questions you want to be asking yourself every single time that you take a trade. All right, they're crucial to accurately reading a candlestick chart. 1, how did the bar, candlestick, right? How did the bar form? Where did the bar form? And how did it get to where it's currently at? So the first number 1 is specifically the specific current candlestick. The candlestick that you're looking at right now, how did that bar form? Okay. Then, where is the bar forming on the chart? All right. Is it 8 bars up? Is it 7 bars down? Is it consolidating, etc.? Number 1 was, hey, is it a topping tail? Is it a bottoming tail? Is this a volume bar? Is it a narrow range bar? Is it a wide range bar? That's how is the bar forming. Second is, where is the bar forming? At the end of an 8-bar consolidation? At the end of a 9-bar run up? At the end of a 3-bar pullback, perhaps? And then, how did it get there? Okay, so where it's forming and how it got there are kind of the same, but they are different. So we'll talk about both of those. Okay, I want you guys to really ask those 3 questions every time you go to take a trade. And there's one more thing you can add on there. Is there a pattern? Right? You could act number 4. Is there a viable technical pattern on this chart? Or am I just getting ahead of myself and being foolish? That's where mindfulness comes in. I'm not going to talk about mindfulness today, but guys, mindfulness is basically the ability to assess the environment in the middle of the environment. Basically stepping outside of your body and looking at yourself and going, are you making an objective decision here, or are you making an emotional decision based on FOMO, based on fear of missing out? Okay? And I know a lot of people do that when they're in a chat room because like, oh my gosh, the moderator is calling it, I have to take it. No, you don't. It has to meet your plan first, and then you take it. Okay, so basics, guys. This one is really basic. I'm not going to spend much time on this. For those of you that are new out there, the green part is the body of the bar. The red part is the body of the bar. But the range of the bar is from tail to tail. From the topping tail to the bottoming tail, that's the overall range of the bar, right? So the body of the bar is simply the open and the close, right? The body of the bar represents where the bar opened, in this case at the bottom, and where the bar closed, in this case near the top. Okay, if we switch it to a red bar, it opened near the top and closed near the bottom. That's why it's a red bar. I know for most of you that are versed in technicals, this is a very basic concept, but there are some of you that are not. Where the bar opens, okay, and where the bar closes represents the body of the bar. Whether the bar is green or red determines where it opens and where it closes. So over here, it opened near the top and closed near the bottom. Obviously, the body will be red. Okay, it opened near the bottom and closed near the top. Obviously, the body will be green. I'm not going to spend that much time on this. Normally, I'd spend a little more time on it, but it's very basic. It tells us who's in control. Buyers are in control on the left. Sellers are in control on the right. But is that really true? That's the question we're going to answer on the next slide. See, it's so easy to say green bar, buyers in control. Red bar, sellers in control. That's so easy. So easy. But that's not accurate all the time. It's not always accurate. This is why we ask ourselves, not just how the bar formed, but where the bar formed. So next slide, we're going to talk a little bit about how the bar forms. A couple slides from now, we're going to talk about where the bar forms. And we're going to start putting them together to get a more accurate picture. Okay? So, classic slide here. Okay? Candlestick formation. At the top, we have green. At the bottom, we have red. Buying pressure is increasing equals bullish. Selling pressure is increasing equals bearish. Guys, that is a very, very elementary, novice, rudimentary, basic look at bullish and bearishness because we haven't added where it's happening. So let's first talk about what is happening. Then we will talk about where. Okay? So if we look at these as number 1, number 2, number 3, number 4, number 5, right? 1, 2, 3, 4, 5, and at the bottom, 1, 2, 3, 4, 5. Okay? Over here on the left, we have a bar that opened at the very, very bottom, went all the way up to here, and then closed right here. Okay? So, at one point in time, there was one moment in time. Who sings that song? There was one moment in time where this bar, the number 1 bar here, looked exactly like number 5 bar. These two bars, number 1, number 5, were actually identical at one point in time. Why? Because they both opened at the bottom. This opened here, climbed all the way to the top. This one climbed all the way to the top. The difference is where they finished or where they closed. That's the difference. Number 5 over here closed at the top. Number 1 over here closed near the bottom. So you can sit here and go, wow, it's green, it's bullish, but is it really bullish? The answer is not really. There's not really many circumstances in which I can look at this particular bar in any capacity and think this bar is bullish. There's really none. I don't care what the circumstance is. Even if you had 27 red bars in a row and then this topping tail bar, there's really not a lot of bullishness here. It's pretty much a bearish bar. Just because it's green doesn't mean it can't be bearish. And that's what I want you to take away from this. Just because it's green doesn't mean it can't be bearish. And just because it's red doesn't mean it can't be bullish. Okay? So this is a fairly bearish bar. Why? The concept I want you guys to be thinking about as we talk about this is battle tested. That concept of battle tested. All right? So when you think about fighters or fighting, okay, It's nice when somebody's undefeated. It means they're probably pretty good at what they do. Probably. But isn't it better if they're undefeated and they fought other great fighters? See the difference? See, if you fought nobody and you win all those matches, it doesn't say a whole lot about you because your strength of schedule isn't that great, right? You see this in college football playoffs, right? If you haven't played anybody, you usually don't get ranked up there with Alabama or Clemson, right? My point I'm getting at, guys, is I want you to think about that 1 through 5 in terms of battle tested. So this stock or this bar started at the bottom, moved all the way to the top, and clearly the commitment from the buyers was not as strong as we thought it was. So this is an undefeated prize fighter who fought nobody, right? Started at the bottom, was all the way up here, right? This person's stock was rising, they're getting paid, and they finally fought a couple good fighters, and this happened. They got smacked. Smack, smack, you're not as good as you thought you were. You're not as good as we thought you were. This happens in trading, guys. It absolutely happens. How often is a stock showing relative strength, and then you get in it, or maybe you're watching it, and all of a sudden the relative strength disappears? It absolutely happens. We traded Facebook a couple weeks ago, was showing incredible strength to the market, and then magically it stopped. Why? Don't know. But it happens, okay? So, even though they looked the same at one point in time, once they got tested, once they got smacked around a little bit, we can see here clearly now the buyers weren't as committed as we thought they were. Now, bar number 2, well, we have a doji bar, right? This thing opened and closed almost in the same spot. Obviously, it closed slightly higher than it opened because the bar is green. But this represents, and these two really, bar number 2 and bar number 3, really, I'm going to lump them together because they're very similar. Realistically, these are doji bars, which means they are neutral. But are they neutral? That's the question. Well, in a vacuum, we don't know, but we don't trade in vacuum. So this bar did what? It went all the way to the bottom, and it was red at one point in time. Went all the way to the top, and it was green at one point in time. Guys, basically this bar right here, I want you to look at this bar. This bar right here basically looked a little bit like this. Not the same, obvious, because it started in the middle, right? Started in the middle. Basically, this bar to the left was all green at one point, right there. All green, right there, all green. And then at one other point, it was all red down here. It was all red. So this thing's giving you mixed signals. It was strong at one point. It was weak at one point. It was strong at one point. It was weak at one point. So how in the world can you determine whether or not the buyers or sellers are in control on a doji bar? How do we determine who's in control when we have a doji bar? In a vacuum, you can't. This is why we don't trade in vacuums. We did a lecture a couple weeks ago on multiple time frame analysis. Check higher time frames, check lower time frames. Why? More information is always better. It makes for a more informed decision. And a more informed decision most of the time usually means a more accurate decision. Okay? So when we look at these bars, yes, there's a mixed bag here. Buyers and sellers are fighting it out. The question is, who is winning? In a vacuum, you don't know. So how do we know? You find out where it's happening on the chart. So we're digging inside the bar right now. We're finding out there's a tug of war here. But if we look at where it's happening, so let me give you an example. Imagine, just hypothetically, imagine for a moment that you had red bar, red bar, red bar, red bar, red bar, doji green bar. Now we have more information. So now you're thinking, wait a second. Red bar means sellers, another red bar means more sellers, another red bar means more sellers, and another red bar means more sellers. So the sellers were in control, right? In control. And then the doji bar happens. So what does this mean to us? What this means is the fact that there's even a tug of war at all means you have to give a slight edge to the buyers, because up until this doji bar, right, we had 4 red bars in a row, 4 big time red bars in a row, which means sellers were in complete control, total control, 100% control. And then all of a sudden a green bar comes in. That's the first sign in a long time, first sign in 4 or 5 bars that buyers are starting to step up. It's the first sign. So that's a good sign. That means likely the stock is going to turn the corner. Now again, that's in a semi-vacuum, meaning we're looking at where it's happening. And I gave you 4 or 5 red bars down. But the next question would be, is that happening 4 red bars down at support, in the middle of nowhere, on a stock that's extended, on a stock that's not extended? So we still need more information, but we're getting there. We went from trading in a vacuum on a doji bar to now knowing it's 4 bars down and then getting a doji bar. And now all of a sudden you're going, you know what? The more information I get, the clearer the picture becomes, and the more I like this stock possibly to go higher. Okay, possibly to go higher. So that would be a scenario where it happens is just as important as what is happening. And you're going to need more of that on doji bars, because there's a tug of war and we don't know who's winning it. So now I want to go over to bar number 4 and bar number 5, okay? And there's a lot of dispute or discussion, bar 4 and bar 5, which is more bullish. At the end of the day, guys, I don't really care, because we're talking about minutia between these two things. All right. One, I think, is slightly more bullish, but only slightly, because we're talking about minutia. So when you think about this for a second, bar number 4 right here, at one point in time, this bar, this bottoming tail bar, looked almost exactly like this. Do you see this big red bar over here? I'm circling it. See this? This bar right here at one point in time looked exactly like this, or very darn close to it. So what does that mean? It opened right here, okay? It opened right there. And it almost definitely, no, it definitely went lower immediately, right? So it opened right here where the tip of my cursor is. See the tip of my cursor right there? It opened there. Went down, 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 down. So at one point in time, it was all red, entirely red. And you're thinking, gosh darn it, there are a lot of sellers here. I don't see any bullishness at all. And then what happens? It comes all the way back up and finishes above the entry right here. Okay? What does this mean? Well, it means this stock at one point had a bunch of sellers in it, but the buyers were committed enough. The buyers were powerful enough. The buyers were motivated enough to push this stock all the way back up, leaving a bottoming tail. It's an unbelievably potent bar. It's one of the most favorable bars that you want to see when you're trading, particularly if it comes at the end of a bearish move. Red bar, red bar, red bar, red bar, big time bottoming tail. That means the buyers have taken control, because the sellers were in control, and then we got a bottoming tail, which means the buyers bought it back up. What does this mean? To me, this is a stock that is incredibly battle tested. This is an undefeated prize fighter who's fought the best and beat them all. Or a prize fighter who maybe lost against a great fighter and came back and beat that great fighter. Battle tested, and they passed the test. You know this because of the bottoming tail. You see, guys, this is where I differ. This is why I give a small edge, not a big edge, a small edge to the bottoming tail over the wide range bar. Why? Because we don't know. We don't know if this fighter's been tested yet. They may have just fought nobody. So we don't know if they've really been tested. Now, that doesn't mean they haven't been tested. So how would we find out if they've been tested? Drill down to a lower time frame. If this is a 15-minute bar, hypothetical, if this is a 15-minute bar, go down to the 5-minute chart and just take a look at it. Is it green, red, green? Well, then that means it's been battle tested on a 5-minute, and likely it's been battle tested, obviously, on the 15. So between these two bars, they're both extremely bullish, unbelievably bullish. But this one you know has been tested. You know that it was red, and you know that there were sellers here. But the buyer stepped up and said, no, we are in control here. It is what? One more level of confirmation. And in trading, our goal is to look for confirmation. The more confirmation we get, the more accurate we can be. And the more accurate you can be ultimately means the more money you'll make, unless, of course, you sell everything too soon, which some of us do. I do that sometimes. All right, so I want you guys to see the dramatic difference. This is why I've spent like 15 minutes on this slide. Hope I'm not putting you to sleep, and if I am, you should quit trading, because this is the essence. This is the core of understanding technical analysis. We're not talking about money management. We're not talking about trading. We're just talking about charts, and I'm going to look at a couple in a minute. But if that puts you to sleep, then you need to find a different business, because this is the core and essence of trading and how buyers and sellers and fear and greed work. Remember, we don't trade charts, we trade people. And this is how people are represented in charts, through fear and greed. And it doesn't matter if it's Warren Buffett, myself, Michael Jordan, anybody who buys or sells a stock is inside of these candle bars, period. Okay? So that is how you understand candlesticks. I'm not going to do it on the bearish side, because you can take everything I just said and flip it. So that is the what is happening. Now we want to take a look at where, right? So you take a look, we go back for a second here. How did the candlestick form? We just talked about that. Now we're going to talk a little about where it formed on the chart. Where did it form on the chart? So let's skip down here. Okay. Now we have a situation where we have decisions to make, because now we're not looking in vacuums anymore. See, we were just looking at 5 candlesticks, 1 through 5. Topping tails, doji bars, topping, bottoming tails, wide range bars. What does that all mean in the context of a chart? Well, let's have a look. So you have a stock overall. We always start to the left. You know, you always hear that phrase in technical trading, look to the left. Well, look to the left. The stock went higher, consolidated out, had a breakout right here, had a little breakout, and then rolled over and failed. And this thing failed pretty big. Why? Because right here in the bottoming tail, you're sitting on support, an area of support right about there, okay? And then it put in a bottoming tail at support after a 1, 2, 3, 4, 5, 6 bar pullback. Normally, what do we expect? Higher prices here, right? See a bottoming tail right there, even with a little bit of volume. I don't know if it triggered or not. It's really close to know if it triggered. Why do we use stop losses? Because situations like this happen, right? Now, is this an area I would have bought? Probably not, but you could see there'd be a lot of traders thinking or expecting this stock's going to bounce. It's 5 bars down into support with a bottoming tail. It's probably going to bounce. And maybe it triggered. I don't know. It's really hard to tell here. It doesn't look like it triggered, but maybe it did. And that's why you have a stop loss. That's where money management comes in. But we're not talking about that today. So this move becomes more and more extended, right? When you take a look at it, there's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 bars, or 10 bars here. 9 of them are red bars. That's the only green bar. 9 red bars, okay? It bounces and goes higher. Now, here's the question. Is this buyable right here? Ooh, that's a tough question. If it's buyable, the only way that it is buyable is because you think this is a parabolic or a climactic move. It's borderline, right? It's borderline. They're wide range bars, I'll give you that. We have a doji bar, I'll give you that. Is it far from the moving average? Yeah, kind of. 82 all the way to 95, $13. You know, that's a good 15%. That's pretty good. It's still aggressive though. But what I do like is the volume spike on this wide range red bar after multiple bars down shows that what? sellers are starting to get exhausted, right? You're multiple bars down, wide range and volume. The people that wanted to get out are starting to get out. And then you get the doji bar, the tug of war. Remember we talked about where things happen? Well, where is this happening? This doji bar, which could be buyers and sellers, we don't know, is happening after 9 red bars and a volume spike. More than likely, because of where it's happening, it's going to bounce. Now, if this happens after 4 green bars up, and that same doji bar, imagine this exact same bar, happens right here, then it becomes a selling opportunity. But it happens down here after 9 red bars. It's likely a buying opportunity. Is it aggressive? A little bit. It is. It's a little bit aggressive. This is one of those you have to kind of make a decision on. For those aggressive traders out there, you probably buy this. For me, I probably hold off on it. Okay? It pulls back again, bounces, pulls back, and bounces. Okay? You see here 1, 2, 3, 4 bars, then you get a topping tail. That's a selling opportunity. But now you have a problem. You have a higher low here. So would you really short this? Probably not, because of the higher low. Makes sense? If this put in an equal low, see this right here, if this went down to the green bar or a lower low, you would likely short this. If this put in an equal low or a lower low, you would likely short this topping tail. 4 bars up, little bit of resistance to the left, topping tail, sellers are coming in, right at the moving average, short it. But it put in a higher low. I'm not going to short that. Now we move up, put in an equal high, right? Topping tail, little doji. And then what happens? It completely sells off. 1, 2, 3, 4, 5 bars. Just for whatever reason. It rips through this pivot. Why? I don't know. It just does. You don't have to have the answer to everything. You only have to have the answer when you're willing to put your money in it. And I'm not willing to put my money on the shorting this right here because of the higher lows. Multiple higher low here, higher low here. There's no way I'm shorting this here. Some of you go, oh, that's crazy. That's a double top. Not after 2 higher lows. It's too aggressive. Guys, here's the beauty in trading. I'm going to get to this pivot in just a second. Here's the beauty in trading. Nobody's forcing you to take anything. If I don't get exactly what I'm looking for, I'm not going to take the trade. I want you to think about what I just said. If I don't get exactly what I'm looking for, I'm not going to take the trade. This goes back to FOMO, fear of missing out. So some people say, well, you would have been wrong. And you're right, I would have been wrong here. But you know what? Missed money is better than lost money. Missed money is better than lost money. I don't mind missing this. Why don't I mind missing this? Because there's 3,000 other stocks to trade. I will find something else that gives me exactly what I'm looking for. Okay? Again, this business isn't gambling. It's not hoopla. It's not how fast you can turn $100 into $1 million, not in 37 days. It's not about that. It's not about all those armchair warriors out there. Okay? It's about real money. So, this stock puts in a double, triple top. 1, 2, 3, 4 bars down. Okay? Tanks. Now again, why did it break this pivot? Why did it break this? I don't know. I can't answer that question. Anybody who can is lying to you. Okay? I don't know. It should have put in a higher high. You have a flat moving average, a higher low, and a higher low. Not a higher, sorry. It should have put in a higher low right here. And then pivot and go higher. But it didn't. It went all the way down. But. Now we're down 1, 2, 3, 4, 5 bars. Okay, one of which is a very wide range bar, a super widest bar I see on the whole entire chart. Maybe this bar is close. Widest bar on the whole chart, like a $10 bar. Maybe not quite, maybe $7 bar. Volume spike right here. Okay, little volume spike on the big bar. Okay, a little bit above average. Volume spike here. Where are we at? We're at support. And we got there, right? How did we arrive here? 5 bars down. Well, let's look at each bar. Okay, a little bit of selling pressure, a little bit more selling pressure, a huge amount of selling pressure, a little bit more selling pressure, big volume spike at support. So when we look inside those bars, we're going, wow, there's a lot of sellers here. But you would think after an extended move into support with a bottoming tail green bar, it means a lot more depending on where it's happening. What is happening? Bottoming tail, doji bar, bullish. Where it's happening, extended move at major support, 100% retracement, level 1 support. Almost definitely you're going to get a bounce here. Are you expecting 100% retracement? Probably not. But you should be expecting a 50% retracement. Would I buy this? Absolutely yes. It's coming down to support after an extended move on volume, likely ending volume. We're not going to talk about igniting volume, ending volume, continuation volume today, but it's ending volume. With a bottoming tail and a green doji bar, this is buyers stepping up. Remember, this bar was red at one point. The buyers made it a bottoming tail. The buyers committed to this. You buy it right here, just above that $80 mark, put your stop right down there, and you try to shoot for the moving average. Sell at least half there, maybe more. Okay, sell at least half there, and then try to ride the back up. Will it get back to 95? Maybe, maybe not, but I'm not expecting this. On this move, I'm not expecting it to break 95. To break 95 is going to have to come up to this area, 90 to 95, and chop around, consolidate, or maybe pull back again, and then break 95 from a higher vantage point. Right? It's going to have to break 95 from a shallow pullback, not a 100% pullback. Guys, you usually don't get 100% retracement all the way back up right after the retracement. Usually you're going to get a half move, 50%, 40% move up, chop a little bit, another move up, and then a shallow pullback, then you break it. Okay? So again, look inside the bar. What is happening? Look at where it's happening. Major support, level 1 support, and then how did it get there? So let's go back real quick. How did the bar form? Right, bottoming tail doji bar. Where did the bar form? At major support, 100% retracement, level 1 support. How did it get there? After a 5-bar extended move on ending volume. Boom, 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 buy it. That's it. You just go check, check, check. You have a checklist. It finishes the checklist and you buy it. So I just went over all that. Now let's take a look. Okay. Everything I just explained to you. 7 bars down. All right. 2, 4, 6, 7th bar down. Several large bars into multiple pivot support. Increased volume. Green bar at the bottom. Bottoming tail. The stock has entered an area where buyers are expected to step up after a 7-bar move lower on increased volume with multiple wide range bars, which typically means the stock is likely tired and ready to bounce, equals high odds. Can I guarantee you it's going to work? No. But really high odds it does. Really high odds it does. And if it doesn't, I have a stop loss for it. I want you guys to think about it. It's not what we're talking about today, but I'm going to throw it in. Trading, technical analysis trading, is just a game of statistical probabilities. That's it. That's all it is. There's never a trade in the world, even if it's the greatest thing I've ever seen, that I can guarantee you will work. But I can increase the chances or the odds that it will work when I start using these reversal signs and I start adding things together and start putting things over top of each other. And what are you doing when you're doing this? You're getting a cleaner, clearer, more accurate picture of what will likely happen. That's all you can do. That's all you can do in trading, is get the clearest, cleanest picture you can with the most amount of information that's available to you so that you can make the best decision possible. After you've made the decision, you live with it. You buy it, target it, stop. If it works, wonderful. If it doesn't, next. That's it. That is it. Okay? So that is today's topic, guys. All right? I think this topic, as basic sometimes as it sounds, is truly the foundation of trading success. How something happens, where something happens, what is happening inside the bar are things that every single time you take a trade, you have to ask yourself. Stop Stop. And one more, stop following people blindly, having no idea or understanding what it is that they're doing. Stop it. You know, this is real money. It's your real money. I don't really care what you do with your real money, but I'm telling you, you're foolish if you're blindly following and, quote, trusting somebody else. What's the word trust but verify? Have it in your trading plan. Verify it meets your plan's requirements. And if you're not sure, ask. And guess what? I don't want to hear it. Well, things happen so fast. You know, if I did that, I'd miss it. Well, then you missed it. There's going to be another one later on today or tomorrow or next week. Don't worry about it. FOMO, who cares? Move on. Just forget about it. Okay? Unless and until you feel 100% confident and comfortable in the trade you're taking, don't take it. End of discussion. And every time you take a trade, guys, every single time that you take a trade, ask yourself those questions. How did the bar form? Where did the bar form? And how did it get to where it's currently at? Okay? Hope you guys enjoyed that lecture. We do this every single Wednesday. I'll see you guys again next week. To get more great educational content, subscribe to the Live Traders YouTube channel. This way you'll get email alerts every time I upload a new video.